This is circumstance of the end of fiat and debt-based system. It is now in an accelerating parabola.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 29th through May 6th, 2024, while supplies last. First, we feature 2023 1-ounce South African Silver Krugerrand at just $3.10 over spot. Next, backdated 1-ounce gold Australian Kangaroos are only $59 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Francis Hunt, the Market Sniper. Francis, thank you so much for joining us today.
Always delighted to be with you. Thanks for having me.
Well, it's great to have you today. I did want to discuss an interesting correlation we're seeing in the market between the dollar and gold. Both have been rising over the last few months simultaneously. We just had Alistair McLeod on pointing this out, and he was saying that this signals that there's really a shift going on. This is not a typical rally in gold. It's more of a, people are concerned about credit itself in this circumstance. And you've said this is really a fear trade that's going on. Can you expand on that?
100%. And the best is always to look in the footprints in the sand, Elijah. So I'll share the chart with it. And I'm going to contrast that with Bitcoin as well, because it's a tale of two different outcomes here. This is the dollar index, Elijah. You'll see it over here. Now, I've started off on an 8-hour. I'm going to maybe just before we go into the weeds here, just go up a time frame a tiny bit. Let's go 18 hours and just highlight how that thick pale blue line got there. So we're technical, we like the charts, and we saw a reversal going down on the dollar index here. And it was a very seminal level at 102.5, and that gave us an inverted head and shoulder. And that's typically a reversal for upside. In other words, we're expecting some dollar strength at that period. And then we had a target around here. So what ended up happening is you had a nice little squeeze, you broke up, broadening, we went and made that 104.7 target. And then after making targets, the reason they're targets is you tend to fizzle and you have a loss of momentum. So now let's take it back to the timeline where we started, which was the 8-hour. And what you'll see is we came back and we revisited that neckline, which is a key level for the dollar right there. So take those drawings off right there. And that turned out to be, and this is an important point because you and I are talking right now, and this will date timestamp us, just before the non-farm payrolls of Friday. Maybe by the time this is out, there will be some answers already. But this was a non-farm payroll day 2 months ago. And it was served as a turning point, and technically we saw that marry up with the 102.5. You started to see in the dollar index that it was reverting back bullish, but that was its current low at the time. Gold had already been moving up before that. Gold had been moving up during this period, and then even more, quite strongly, into that dollar weakness. So while the dollar was weakening, gold was strong. That's the typical relationship. As you've just mentioned, your previous guest was pointing out that gold was going up on a stronger dollar. So since that non-farm payroll, actually there's been more, my personal take, and I agree with Mr. McLeod, my personal take is that we're actually getting the gold now as a higher fear trade value against the sustainability of the system, which is the capital preservation respect that I've said it always deserves because of the debt market collapse. So while the dollar has actually worked its way stronger, this is against the key suspects, the main currencies that includes the Swiss franc. The euro is the predominant part, around 53%, a bit of pound in there, and obviously a bit of yen, which isn't exactly doing that well. So it's dominated those currencies. However, once the dollar index pivoted and it had a secondary low here, marginally higher. And we'll come back to that when we have a look at Bitcoin. But you could see it move quite firmly up. But gold was flat for a short spell and then continued to go up. And in actual fact, it's almost trading more like the Dixie in this most recent phase, because the expectations were for big rate cuts. They haven't come. They continue to get pushed out. It's a case that we've always made. They can't cut near as far. They can't do near as big. And it will be one of the few truisms that the Fed said, higher for longer, on the basis that they need debt to devalue, and debt to devaluation. Yeah, and there's not the bid for it to do anything else, by the way. Recent issuances have been terribly covered. There's no appetite at all. And the last buyer of last resort will, in fact, be the Fed itself, or the mysterious offshore entities in Belgium, as I sometimes like to joke. So you can see that in actual fact, since this point here, gold and the dollar have largely moved pretty much in tandem. Only, I must highlight, gold has done more than the dollar. So it's an outperformer in the fiat trade and the capital preservation trade. Now, dollar often goes up when everybody is scared and afraid, you know, the safety of US Treasuries, etc., and the currency gets bid in crises. And what we're actually seeing now, that Alistair was highlighting, is gold was going up on a strong dollar. And that's one of the big shoes to drop. Now, many people will say, well, it's going down now. Well, the dollar's having a bit of its uncertain period too. And we're about to have the biggest data release of the month come tomorrow, which being Friday, which is going to be very, very interesting for the direction of the dollar. So if the expectation is, no, there'll still be some cuts this year, we're not cutting it back that much, you might get weakness in the dollar. And my expectation is this falling wedge could break to the upside on that. Don't forget, gold was going up while the dollar was weak. It's the natural counterparty relationship, and it certainly does well when the dollar is weakening. Even if it strengthens, let's say we get a blowout big number on non-farm payrolls, that's actually going to create, again, the double trap that they've now created for gold. Well, that means fear. That means rates are going to stay high. Everybody else in the rest of the world is going to suffer because they're going to have to match rates. Otherwise, they'll have the pound crisis and the pensions crisis that the UK had. They'll have what the Japanese are currently having and desperately need a break from their devaluing currency. And that, again, could see gold go up. So it's kind of heads, gold wins, and tails, the anti-gold guys lose. So it's kind of either way, gold is a winner at the moment. So I'm not overly concerned by this pullback. This looks really good. And I do just want to contrast it, Elijah, as part of answering you. So I put the two charts on at the same time. I'm going to take the gold out, and I'm going to say, whilst there's a key point I want to make here involving Bitcoin, which is supposed to be the digital gold. Now, obviously, it has gone up immensely in percentage terms. But if we just have a look at this chart on the same time frames, the high for Bitcoin was over here. In other words, it was roundabout, you see the 8th of March, that was the low for gold. It went up and it went down, and then it started to go quite strongly up. So that was another localized low. That was top Bitcoin. You had a little bit of initial momentum climbing over here. You had a leading indicator with the possible turn in dollar. It wasn't strong yet. It eased again. And then from that move up, Bitcoin has been down. That was at 74K high. And since then, on the strong dollar, it's actually performed quite poorly and is down here at around at the 59 after trading 56. 74, 56, it's not insignificant. Now, this is typical around halvenings, but and this is not a bear call on Bitcoin. I do think it will shrug this off and it'll go up. And being a high beta, it can indeed go up faster than gold. But when it comes to real fear, the big money moves the markets, and the central banks are buying gold, not Bitcoin. Now, BlackRock will rush to tell you that they're going to go sovereign wealth funds and central banks and everybody. That's still to happen. At the moment, people choose gold when there's uncertainty, and that would be my take.
It seems like there definitely is a shift going on where we're seeing these markets act in a way that not a lot of people who have been tracking markets have seen. Now, when it comes to the precious metal markets, gold, we are seeing a bit of a pullback here, but it sounds like you think that's going to be short-lived. I know a lot of clients are calling me and asking, if they want to add to their position, should they wait for a further pullback? Your perspective on the price action going forward from here.
Yes, let's just go to gold on its own, shall we? And just do the deep dive on it. I'm just going to move that a little bit out the way. Here we go. This is gold. I always think you want to start from the big time frames. Remember what continent you're on, kind of that thinking, and then you drip down to state level, municipal level, home, street level, home, back garden, beach chair, the sun lounger. So start from top down. This is a macro bull. And this isn't even the biggest of charts. I can take you pretty far out. In fact, you can argue that since 1977, you're actually in an extended, largely bull market, which counters the fact that we're in central bank policy is largely inflationary. However, you've had very long pullbacks that most people would say are bear markets, unless you live 1,000 years. And a decade is just a moment in your lifetime. But that was obviously on the log scale chart, an extended bear period. And that represented the financialization of everything, the success of the free float, the 71 removal of the gold fix. And then you had got your next stage of bull market. You then again got a pullback. Most people, again, would refer to these as bear markets because of the duration, but it all depends on your time frame. If you're up here, for me, you're still in a bull market. This was all a basing out structure. Yes, it took decades to happen, but you can wait decades for anything to happen, and then decades happen in weeks. And we've broken this key level at 2K and out of this pattern on the monthly time frame. So this is a macro bull. So to your people that you're speaking to, going back to the 3-day charts to just get us back into the recent price behavior, this is a pullback period, but I would accumulate on dips. I would certainly accumulate on dips and dollar cost averaging. If I had a huge lump sum and I was adding gold to my portfolio for the very first time, I might hold out to see if I could get a tiny bit lower, but I'm not sure. This points to a falling wedge generally, and typically we talk about the 3 impulse falling wedge. So falling wedges are by definition continuation patterns, and we talk of a 3 impulse falling wedge. It certainly looks to what we define as the 3 impulse falling wedge very much in play. So a bit grindy on the bull side, kind of steep and brutal on the downside. You see those momentums, a bit not so good for metals. Again, a bit flag-like of a grind, but this time the sell-off is brutal, but shorter. And now on the upside, we're a little bit more lively, and you've come back down, and now it seems like support. You often get a support point in that third. So the breaking of this capping descending grind line that I've doubled up for you in pink will be the beginning of a reassertion to upside. So this strikes me, even going back to my lump sum right now for the first time, I actually don't even think it's a bad time right now. There are 1 or 2 events that could work against you. Sometimes you get to pop out the bottom first before you break to the upside. But generally, I would expect this falling wedge to resolve to the upside with a break of this double line here, which I've now put a blue stripe in the middle of. So I think it's a great time broadly, and you'll be a bit unlucky if it dips on you. And anyway, it should be an investment. So if you did get this scenario with a dip down, you just keep on going and you keep pedaling, and you accept you're not there to make green in the first day. You're there to preserve capital on the long haul. So either way is a buy.
Now, when it comes to silver, obviously we're far from all-time highs, but we've seen quite a run-up in the last month or so. What is your perspective on the current price action we're seeing?
Yes, it's very important to understand, and we had this discussion to some degree in a roundabout way in previous chats that we had. Gold is the leader. You should always start with gold being predominant. Silver should be something that I still think you should have it personally, but you shouldn't be overweighted, and it's something you rotate some of your gold into as everything really begins to kick off. And the gold silver ratio is the break that you want to have happen for when you then start overweighting silver. So initially you start overweighting gold. You still have some silver, you overweight gold. But in the same way, a key level and shoe did drop, Elijah. When we've been showing you this pattern for, eons. It feels like eons. This was around about 2020 when the high. You had the Wall Street bets there. You had another attempt, knockback. You had quite a few knockbacks on this capping descending grind line that we've had. This is the first break above this level. It ran really far in quite a short time, and it had come from that secondary low. We called it a soft floor at 22. Apart from a few small spills, you started to show great respect for the 22. So you've actually done quite a bit. 22 to around 28, 29s was a good run. To have a pullback of 38 or 50% is absolutely normal. Bear in mind what I just said to you about gold. For now, silver is still the trailer with the big fat bungee cord. It needs the 4x4 to be driving to maintain momentum. There is a lot of tension in that bungee cord, which is a peculiar version of a tow bar. But if we drop it again to the lower time frames, it's doing very similar technical structure. So just tidy that up. You've got the same falling wedge. It just is a higher beta. So in percentage terms, it comes off more, but technically it's mirroring gold. So when this breaks, I would still expect it to outperform gold, and we should start to see that gold-silver ratio that we're always talking about also come back down. It's still in its flag, so maybe I should get that up. So I'll grab that. That's the T-bills. We'll grab that. As we've said, while we're seeing those T-bills, remember, the debt market has turned irrevocably in our view. In other words, generally rates will only be going up if debt will be devaluing. That's our default scenario. Cuts will be minor, short-lasting. So if we let the lines back on and we drop down to a smaller time frame, that triggering event that we keep talking about occurs when you break that red dashed line. And it's getting really, really hard for this gold-silver ratio to keep plowing, because the problem with this level, Elijah, is that it keeps marching up. So you have to keep undervaluing silver by ever more. And eventually that doesn't hold. It simply doesn't hold. It's not found in the levels it needs. It's being consumed. That was typically our splitter, how it runs. This is turning into a bit of a shooting star. So you're wicked up to our midpoint, and now you're being sold off. By the end of the week, this could be a red candle, even though there's only what's left of today and tomorrow to play. Because if the dollar comes in weak, big moves happen on a Friday when it's live trading day with us and non-farm payroll day. And we always do live trading because that is such a key event, and it sets you up. If you're on the right side of the macro trend and you understand what the dollar is going to do, you've got a better chance of knowing what Bitcoin, gold, and silver will do. Although, as I've already highlighted, the precious metals have shown they can go up now on the strong dollar. So if we get the right kind of NFP number, this could come back down, and we could be asking the question. It has cried wolf a number of times with us, as I like to say, but the bigger and the more times that happens, the bigger the move. Remember gold breaking that big flag pattern that I was showing you in the first instance on the bigger time frames. We were waiting a long time for that to happen, and then it just broke, treated the 2K as support. So the 2K is that blue line, and then it spat up really strongly. So the wait is worth the while when the action comes. And it was once, twice, three times, and the fourth time a lady, and we got the same with silver. So when that gold-silver ratio breaks, the longer it's been held off, the better the move you end up getting, which is why, as we assert, it's going to be disorderly to the downside when it breaks. Because eventually that dam wall pressure is building, the water's getting too high, it's getting bigger, the structure can't hold it, and when it eventually smashes, you actually have megatons coming down. It's not some small break. And then I would expect it to trot right down through 65 in short succession, running through 75, right down to 65. And that's when we might get our first little bounce back. And I think gold and silver are at significantly higher numbers by the time that occurs. We've suggested that you could be in the 45 to 50 range by the time you get down there. And then you will know if gold is 65 times that, roughly where your gold price would be. It's probably worth doing the mathematics if you'll indulge me. So if we, let's say the low side of 45 and we multiply it by a 65 ratio, you're going to be at the 3,000 target that we've suggested you should be making. And then I would expect a little bit of pushback, and then we'll go into another stall period. But on top of that, the stall periods are getting less.
Now, coming full circle, kind of to understand what gold may be about to do, can you expand for our viewers kind of the different kind of market we're in right now? I mean, this isn't another 2008. What gold, the US dollar, Bitcoin, what those, and interest rates as well, all of those are signaling is a loss of confidence, right? A fear trade. How does this differ from, what we saw in 2008 or in other crises that people tracking markets right now have experienced?
So the big thing about 2008 that doesn't apply in 2024-25 is that previously everyone trusted treasuries, and the dollar was the main fear trade, and gold wasn't particularly. Didn't do badly, but it wasn't the primary beneficiary. You didn't have central bank buying at the rates that they were buying recently. And what has changed, and also the scope for proliferation and new money and new levels was still in existence in 2008. That runway, that bit of extra runway, has already been deeply used. So you're sitting in a scenario where people are now viewing treasuries as having a risk premium of failure. So if you take the shadow stats, which has you at around, I think it's around on 1980s number, he's got it at around 12.5%. So basically taking the formula of 1980, that's Reaganomics. If you apply that, the average American is facing 12.5. And that means you're getting a guaranteed loss of around 7.5% right now on treasuries. So in terms of how much things are going up, your living costs, things to buy, we've spoke about the softs in many videos recently. You've had coffee, both beans, Robusta and Arabica, absolutely running. You've had cocoa, absolutely running. These are, where technology has expanded, bigger scale is applied. These are inherently disinflationary because we get better at getting more beans out of the ground, etc. And what's actually happening is, cacao's gone up since October last year, 245%. Yes, they're having a little pullback now after a major move. Yeah, both coffees gone up, substantially. Robusta almost 100%. It's the cheaper bean. Arabica around 65. These are things that are the last things to ever go up. So this tells you dollar devaluation, not against other currencies, against everything else, not just gold, beans. Good old coffee beans, good old cocoa beans. It's losing value against everything. They'll try to explain away, oh, there was a flood here or yields weren't so great. Actually, delivery and crop sizes are pretty consistently good across most of those. There's been no major blowouts truly in any of those yields. This is circumstance of the end of fiat and debt-based system. It is now in an accelerating parabola. I have a chart that says very prettily, the biggest yield curve inversion as a reminder, as a parting shot. You never return back positive into a yield curve without a major crisis. And in fact, in one instance where you didn't go fully negative, it was still the events of CV19 is highlighted there. That's your subprime inversion. That was your dot-com inversion. And at the moment, we are still inverted, but we are heading up. The crisis is imminent. And whilst everything could sell off if it's big enough, gold rebounded double quick time and went on to absolute new highs in 2020 last time. You're 4 years later, we're about to have another crisis with another election. So it's not quite the guy who's in charge's fault. It's not quite the new guy's fault who has to clean up. This is ominous. And one thing that will preserve value, cash, a little bit of cash in the crash and the rest in gold. That's how it feels to me.
Francis, we really appreciate your time today. If our viewers are interested in continuing to track this with you, where can they find you?
Yes, we'll post out a link on our X profile through the Market Sniper for our live trading day tomorrow. A lot of what I've said is there's a key direction that's going to take place. Is dollar going to dominate again for a third month, or is it going to turn the other way? And that number and the market's reaction will determine that, and we'll be doing that live. You're welcome to join us for just that, as for a try before you buy. It's a very low price of $197. There's a link if you want to do that. Get to know us more, follow us on the YouTube, The Market Sniper. And if you ever feel ready to book a call, themarketsniper.com is where you do it. Thank you for having me on, Elijah.
Any last thoughts before we let you go, Francis?
Most of my last thoughts actually don't deal with money and financial issues. Don't get despondent. Don't let people peddle fear to you and make you fearful. Every day is a gift. Wake up, seize it, love it. Live it like it's your last day. Do a small item of preparation as often as possible most days. And the rest of the time, live, dance, love your dog, do all the things you should do and embrace life. And you can only prepare as far as you can. Those that hold gold and silver will be best prepared. Taking action is really powerful for mindset, and you've got to look after yourself physically and in mindset terms for what's probably looking like a little bit of a bumpy ride.
A little bit of a bumpy ride, definitely. Francis, once again, thank you so much for your time, and God bless.
Same to you, Elijah. Bye-bye for now.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 29th through May 6th, 2024, while supplies last. First, we feature 2023 1-ounce South African Silver Krugerrand at just $3.10 over spot. Next, backdated 1-ounce gold Australian Kangaroos are only $59 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.